Hi, this is Jason, Chief Technical Analyst with ToroAlerts with your weekly market recap for the week of August 22nd. We had a down market in the week across the board. Saw crypto as well as the major stock market indices all down on the week. So let's dive into the charts and take a look at what we're seeing here. Starting out with the Bitcoin chart, we are sitting at about 20,700 on Bitcoin currently. We saw a pretty good, decent sell-off today after the Fed comments from Jackson Hole. Both in Bitcoin as well as the major indices, and I'm not really looking for any kind of crypto trades, at least to the long side for the time being. It looks like the altcoins as well as Bitcoin and Ethereum are all down on the day and also down mostly on the week, and so I'm really not looking for any long opportunities currently in the crypto space. I actually have a short on Bitcoin currently that I got into when it broke the 21-day EMA back when it was at about 23,500. So continue to look for short opportunities, and we'll probably keep the short on Bitcoin for a while now. I think we'll easily get back down to the previous low, which was right around 17,800 to almost 18,000, and I think there's a good chance we head lower from there as well. So not looking for any long opportunities in the crypto space for the time being. And then jumping over to the S&P 500, our SPY chart, saw a big sell-off today on that as well. Started out the day opening right around 420 on the SPY and closed down at about 405. Looks like it's selling off post-market in Friday as well. And so things are looking a bit rough if you're trying to go long on many things right now. Right now I'm sitting in quite a bit of cash and looking for short opportunities. I've got a few shorts in place. The next one we'll dive into over on the NASDAQ, the Triple Q chart. I put a short on that one after we kind of rolled over last week in the markets, and that one's been working out really nicely, especially after today with the sell-off on Friday. I think we're still heading lower on the NASDAQ as well. I'll be looking for maybe a possible, not a long-term bottom, but maybe some short-term support right around that 282 level on the triple Qs. But I think we are heading lower further from there. So looks like a good time to either be sitting in cash or looking for some shorting opportunities in the market. And then taking a look at our Dow Jones Industrial Averages, big sell-off in the industrial averages as well. We dropped below a major support area right around 325 that didn't hold, and it looks like we are heading lower on the Dow Jones as well, just above the 50-day moving average, but I don't think that'll hold as support for more than maybe a day or two if it does at all. And I think the Dow Jones Industrial Averages are likely headed lower as well. And then we take a look at our Dow Jones Transportation Index. We saw a sell-off on the week on that as well. We did close out the week right around a key support level at about 14,360. So we'll see if that holds next week and if the transports can bounce back. But based on current market conditions, I probably expect that won't hold the support, and we'll probably head lower from here on the transports. And then taking a look at our Russell 3000 chart, we talked about 2 weeks ago how we were looking for a possible top right around that 50-week moving average, and it just about touched that almost perfectly and started selling off from there. This week we saw further selling pressure to the downside as well, and now we're sitting right around this center channel line that may act as support briefly going into next week. We'll have to keep an eye on that, but I think really over the next week or two we'll likely break that center channel and head lower. For quite some time now we've been talking about, all the way back in November of last year when we were at the top of this channel, that the most likely outcome would be that we'd at a minimum get back down to the lower end of this channel, which would represent, depending on when we hit it, probably right around 2,000 or so on the Russell 3000. So definitely looking bearish there as well. And then when we take a look at our Russell 1000 chart, the IWB, we talked about last week if we had held support at that Fibonacci extension level, that might be bullish for large caps, but that did not occur. We opened the week up right around that Fibonacci extension level and then just continued to sell off from there. Closed the week out at 223 on our large caps, and looks like we're heading lower from here. And then take a look at our Russell 2000, our small cap chart. Similar story here. We actually peaked out right at the 50-week moving average 2 weeks ago, and we've been heading down from there. It's looking like we'll likely head lower on the small caps as well. Might find a little bit of support right around the 173.50 level on the IWM, but wouldn't shock me if we headed lower from that level as well. So I've actually got a short in on the Russell 2000 right now, and that's been working out pretty nicely. I got into that one last week, right when it topped out around that 50-week moving average. And then looking at our growth versus value chart, growth has been a pretty strong outperformer over value since about May, towards the end of May of this year. It looks like that might be rolling over now though, and so we'll have to keep an eye on that, but it's looking like value might be the outperformer here going forward. And either way, probably not a lot of great longs at the moment, unless you're maybe looking for some energy trades. But most things are looking pretty rough right now, especially after this Fed comments today. And then when we take a look at our relative rotation graph, this is our sectors that we track, taking a look at the last 10 trading days, so the last 2 weeks. And we can see right at the top here that energy has really started to rebound. We're looking at the XOP, oil and gas explorer and production, that is up over 8%. Energy, the XLE sector is up 7.5%. Natural gas is up over 7%. So those are the clear leaders for the last couple of weeks, and that's all in the energy space. Energy is starting to look like it's heating up, and so that's the one sector that I'm kind of looking at for some long opportunities. But I'm currently not in any energy trades at the moment. I'm kind of waiting to see what happens from this market shakeout. Even in the most relative strength sectors, if you've got a real big sell-off in the markets, even those could underperform. So I'm kind of sitting back patiently, looking for potentially some further sell-offs from the markets going into next week. And if we start to see the energy space bottom out and start to head back up to the upside, then I'll probably be looking to put on some trades both in the natural gas and energy space. And one of the main reasons I'm not getting super aggressive on energy right now is taking a look at this U.S. oil chart. We have been sitting in kind of this limbo spot for 3 weeks now. We've really been bouncing in between this bottom channel here as well as this 50-week moving average. And so as long as we're kind of chopping around between these two ranges, it's still kind of uncertain where the direction is from here. My bias would be to the upside, but I'd really like to see the price action get above that 50-week moving average and close on the week before I get super excited, or if I just see a massive thrust up to the upside. But as we can see here on this weekly candlestick, we did get as high as almost about 95.70 or so on the U.S. oil barrels, but that did sell off a bit and ultimately closed the week out right around $92, $93 a barrel. So I'd like to see a little bit more bullish action out of the barrel prices, and then I'd be getting a lot more excited and more aggressively long in the energy space. If you're wanting to take a few more shots, probably nothing wrong with getting into some energy trades right now, but I'm sitting back and kind of waiting for possibly one more little dip, and then looking for probably some good buying opportunities in the energy space. Other than that, really not looking for a whole lot of longs currently in this environment. And then taking a look at our CRB Index, our commodity space. Commodities did actually have a pretty decent move to the upside, so that is heading pretty bullishly to as we broke out of this kind of trading range we've been in for about the last month or so, and so things are starting to look somewhat bullish in the commodity space. We are getting back up against the center channel line though, and so we'll want to see really how it reacts to that. As we can see down lower here on this chart, there was quite a bit of resistance in the center channel, and it took a long time before we were able to break out above that level. And so this may not be the best place to get into a long trade on the CRB Index, as we might just be close to a top, and then we might see a rollover there. So I really want to see how it reacts to that center channel line before I kind of make any decisions as far as going further bullish in the commodity space, or potentially looking for it to roll over from there. So we'll probably get a resolution out of that next week and maybe see where commodities are heading from here. And then taking a look at our consumer discretionary versus consumer staples. This chart gives us a great idea as to whether or not people are have a risk-on appetite or whether they're getting more defensive. And we can see over the last 2 weeks, people have been more defensive. Consumer staples are outperforming consumer discretionary. So defensive sectors have been the winners over the last couple of weeks. And that tells us, I think, that that also coincides with about where the market started rolling over, and I don't think that's any coincidence. So I think the bias here is that we're likely headed lower, and defensive sectors are going to be the better place to put your money if you're making any trades outside of energy, if you are looking for those long opportunities. And then taking a look at our VEU, the Vanguard All-World ex-US chart that we look at here. This is our global markets minus the United States. We did see a decent little rally for quite a few weeks, and that has rolled over in the last 2 weeks or so, and it looks like we're likely heading lower from here on the global markets. And when we look at it on relative terms, we can actually see that on a relative basis the global markets outperformed this week. But don't think that's all that surprising, because we did talk about how this bottom channel has acted as support quite a few times for going all the way back to February of 2017. And so that's been a pretty strong support channel to watch for, and so it's not super surprising to me that we had a little bit of a bounce off of there. If I was really going to look for any bullish activity, I think out of emerging markets, I probably want to see a break above this other channel line here that has not been able to break above for quite some time, and so we'd want to probably see a clear break above that if we were going to get bullish in the emerging markets. I'm not really looking for those kinds of trade setups currently. And then take a look at our high yield corporate bond ETF, the HYG. We did peak out at that 79.50 level, which has been a big support resistance zone, and it did act as resistance and rolled over from there. So we've had a pretty big sell-off on the HYG for the last 2 weeks. Thinking we'll probably head lower from here as well. We do have that 75 level that's been a big support area in the HYG, but we did fall below it once already back in early June, and I'm guessing that we'll probably see a fall back below that 75 level on the HYG somewhat in the near future as well. And then when we look at the HYG on relative terms compared to traditional treasury bonds, still kind of chopping around the center channel. We haven't broke below this level. Last time we broke below this level, it was a good indication the markets were selling off even further. So I think there's clearly some more pain ahead, especially once we drop below that 0.73 level. Then I think that'll be another signal that markets will be selling off further as well. So that's looking fairly bearish as well. And then when we take a look at our metals markets, taking a look at gold first, we did have a pretty nice move to the upside on gold for about 4 weeks. That did coincide with rates on the 10-year rolling over a bit, but that's changed and is starting to rise again, and so we've started to see the gold market sell off a bit, and really have seen about 2 weeks now of pretty bearish action in the gold markets. And then when we look at silver, it's been pretty bad as well. At least if you're looking for long opportunities there, we did go all the way up to that 200-week moving average. That did act as resistance, and then we rolled over from there. So we've really been looking at about 3 weeks now since it peaked, and it is looks like it's heading lower. So if we do continue to see a silver sell-off, we might find a little support at the bottom at the last bottom we had, which was right around 1670. But I could also see potentially seeing silver drop as low as maybe $15.50 or $16 an ounce, and I would think that would probably be a pretty solid floor in silver if we do head lower down to those levels. But definitely not looking for any long opportunities in the gold or silver space right now. And then taking a look at our rates, our 2 years up on the week. We're sitting at about 3.38 on the 2 year. And that's up from last week, and it looks like we're kind of breaking out of a bit of a choppy area on the 2 year that we kind of been bouncing around in for the last couple of months. So it looks like the 2 year rates are heading higher from here. And then when we take a look at our 10-year rates, we closed the week out just above 3%. Moved to the upside on the week. We did close last week just below 3%, so not a massive move to the upside on the 10-year, but nonetheless it moved to the upside, and it looks like rates are continuing to head higher for the time being. And then when we take a look at our 30-year, we did see an actual small decline in the 30-year this week. We did see an initial spike on that, and then a bit of a drawdown, closing the week out just about below 3.2%. Previously, we closed the week out just above 3.2%. So just a slight decline on the 30-year on the week. And we'll see where we head going into next week from there. And then taking a look at our yield curve, our 10s minus 2s. We had a pretty big surge for the previous week, moving to the upside, and then it did hit that negative 0.22% level. That acted as resistance, and then we started heading lower from there. So I think we'll likely see the yield curve continue to invert further and deeper from here. And then taking a look at our VIX, we've seen the VIX hanging out well below 25 for quite some time now. We actually got even below 20 for a while, but then this week we saw a move back up above 20, and then a bit of a gap up, and then a massive move up on Friday after the Fed comments, and we closed the week up above the 25 level. So I think that's a fairly significant development. People are getting a little bit more spooked in the markets, and I think we'll likely continue to see some selling pressure across the board. If we start to see VIX above 30, I think that would even be more of a concern as far as the market selling off further, but definitely not looking super bullish pretty much in almost any of these charts that we're looking at right now. And then we take a look at our put call ratio. Anything above 1 is elevated put buying protection. We are back above 1 again, and we actually about 3 or 4 days ago saw a massive spike as well. We were damn near 1.5% on this ratio chart. So there's a lot of put buying protection. People are getting on the defensive in the markets as well. Go ahead and close out the week with what I think is one of the most important charts in the market, the DXY. I think where the dollar heads from here is going to have a big correlation as to where the markets go. If we continue to see a strong dollar, I think we'll see the crypto space continue to sell off, and we'll likely see some pressure in the markets as well. So if we see a drop below, call it about 107.70, which has been a pretty major support resistance area. If we see a drop below that level, then maybe we'll see the tide turning there, but I think my bias is to the upside on the dollar, and we're likely heading from here, as we did close the week up above that 107.70 level, finishing the week off right around 108, almost 109 on the DXY, and it does look like we are headed higher from here. So as long as the dollar's continuing to rise, I think that's bad news for most of the markets. If you're at least looking for long opportunities right now, as long as the dollar keeps rising, I'm okay with it, because nothing I've got in the markets is long at the moment. I've just got a few shorts in place. So if we continue to see that dollar rise, I think that'll just continue to support the idea of looking for shorts in the market going forward. Thanks for tuning in. Make sure to download the ToroAlerts app on the App Store. We've got one for stocks and one for crypto. And like and share the video, and we'll see you next week.